We'll bring it to you right shortly. Now, here we are. Okay, today's Money Smart Show, May 25th, 2024. Special guest, Alan Porter. My name is Brian Johnson. I'm a president and portfolio manager of the Moonrun Report, and we have another show going on for you today. Here's a disclaimer. This talk on portfolio management and drawdown control is designed to educate investors to identify clues to the market based on stock market data. There is no guarantee that any signal will be timely or accurate. Investors should be aware that the analysis here is designed to inform, not avoid all losses that might be incurred. Past performance does not guarantee future results. We're bearish. Here's why. Okay, here the market has, as we start here was a major buy signal. We went in and bought stocks and it turned out. This was a minor sell signal. It said, do not buy, do not sell at this time. And we kept our stocks in there and went up there. And what happened is that we came down, and this is now a shortable correction call, which says it's going to be a time to be selling, but and taking advantage of the downturn, but it's not going to be a bear market. Okay, and then we went back up again, and okay, this is a minor buy signal. It says do not buy stocks at this weight, and we have come down. So we are in a mode where, okay, what happens? We're just waiting for this whole market to turn around and give a major buy signal and go back up again. So the market strength indicator here is shows how strong the market is. When it's below this blue line here, it is below 3.8%. We have a weak market, but above this 3.8 line, strong market, and this other one, the 4.5 line, means that the market is very strong, and I use that as the measurement. Okay, that's good news to know. And here's a confidence index. This turns up when the market's bullish, and then when the lines cross, we have this marvelous thing down here. Sell here, and then we're waiting for this thing to turn around. Actually, this line here, the difference of the confidence index has turned down a bit, so maybe we're going to be in for a little bit downturn. But the market is just not exciting here, low volume, and anyways, this is the Nasdaq, this is the New York Stock Exchange, and that's what it is. Here's the internals. Confidence internals. Okay, New York Stock. This is based on the advanced decline, data, the up down volume, and new high, new lows. And this is the internals. This is the Nasdaq. This is the New York Stock Exchange. These have started to turn down, as you can see. A little bit of weakness in the market, but still above the line. And I think now, in my opinion, we're going to be in for a decline here, about 10 to 20%, and that's what it is. Rate of decline is the shortable correction signaled on April 10th. Now, later on, we had a minor buy signal that's down here, but when we got the shortable correction, the rate of decline came in less than, it just means that it's a correction. Anything above 190 is a stalling out. Anything below 190 is a correction. So the number of new lows is greater than 30 at the top. Greater than 60 at the sell signal means that the market is weakening. That's what it means. And then the new lows calculation comes in at greater than 40%. So the market is weakening as well, a little bit of force down there. So all tested true. And now minor buy signal, market went up. Trigger the buy signal, but the PEP indicator, which indicates whether it's a strong market move or not long market, not a weak market move. It was a weak market move. It was below 3.8. Anything above 3.8 is a strong market move. So we have a minor buy signal. So don't go out and buy stocks. You just stay in cash. Moonrun report and how you can use it. Okay, we are $10 a month. First month is free. Great value for what you have. Here's the intent. Invest in proven portfolios to generate high returns. Sell out before a bear market hits. Buy after the bear market is over, and then we cash out. There we go. So my track record, world champion 2008, run up 2009, bond timer of the year in 2019, Doing very well in fidelity account since 2008. That's commendable, 20%. Harvard Financial Digest, number one for the past 12 months. And it was a 24.47% gain for last year. Called bear markets in 2008, 2011, and 2018. And commendable. And I'm trying to keep it up to par. Research began in 2005 when I discovered the tsunami indicator. Woo woo, right? Okay. What the Moon Run report contains: 7 portfolios? No, it's now down to 2: small cap and large cap. I trimmed these portfolios because I realized that, all the worry about market timing and all that stuff doesn't mean a crap. It doesn't. The portfolios perform the same with market timing and without market timing. And something, over the long term, it's all the worry and the work that I put into it and all that stuff. If I had discovered these portfolios, maybe it would have been worked out, but really not. So anyways, and now I have 450 stock portfolios in portfolio 1, 2, 3. Designer models, no charge. Charts describing indicators for bear market. Okay, that's for in market direction. In my website, the bear market signals, tsunami indicator, 50 new lows rule, accelerating new lows, and then the last one is sharper correction. These all determine when they come out. When they get back into the market with PEP indicator and all that stuff, we get updates on Friday nights just to tell you about what's happening. Stock replacement on Monday mornings if necessary, and first month free, $10 per month thereafter, and database available for one-time fee, $10 for Russell 2000 and $10 for IWM. Examining the portfolios. Okay, we have a new format, 2 portfolios instead of 7 or 8. Moon Run report portfolios have changed from timing to non-timing. Surprisingly, timing makes no difference in portfolio performance. I have some of the best stuff in the business, and it doesn't matter. And I was very disappointed in thinking that that's the way it is, but that's the way it is. Timing is, however, available for subscribers. These signals, major and minor time buy signals will also be included. Investors can exit and enter when they please from the portfolio. Small caps. Backtest from 1999 to 2024, 41.01% compounded average growth rate. That's not too bad. Maximum drawdown is 68%. Of course, that was then the 2008 bubble bear market. Turnover rate kind of high at 4.29, but that's the way it is. Minimum average daily volume, 50,000 shares per day. Search universe, 15 million to 50 million market cap. And here's a chart. Not too bad, 650,000% over 25 years. Large cap portfolio backtest from 1999 to 2024, 23.83% compounded average growth rate. If Warren Buffett is doing 20% a year and this thing's doing 23.83, the numbers matter, and I'm doing better than he is. He's done nothing more than be an indexer for the last, since 2003. He hasn't really done much, and everybody bow down and worships him, but that's the way it is. Maximum drawdown is 50.58%. Turnover rate, 72%. That's really low, I think. Minimum average daily volume, 100,000. Is it 100,000? Yes, it is. Search universe, Russell 1000. Okay. So, no, actually, this should be a 1 million. Okay, sorry about that. That's the way it is. 24,000 shares per day. Not shares per day. It's a percent gain over the last 25 years. Altogether, 32.42% average compounded growth rate, and that can't be beat. Okay. How much $100,000 invested becomes? After 10 years, large cap portfolio against 23.83%. So it becomes $847,000. 10 years, small cap, 3,108,125, 41.01%. How much $100,000 invested becomes? 15 years. Large cap, 24%. Small cap, 48%. And combined is 31%. $6,749,000 $9.99. So that's the way it is. So then we have clips on the internet. No one calls bear markets like Brian. 2-minute YouTube videos describing the feature of the book Before the Bear Strikes, Moon Run Report, The Money Smart Show. Go to YouTube and the Money Smart Show in the search box. You'll see at least 24 shows in there. 1987 to the present, bear market calls and back tests. Various commentary, helpful tips. And here's the last item I have on my list, the decam timer. I wanted to introduce this. It's a timer I constructed from falling out of favor with MACD. MACD has just too many trades. It trades a lot. It has a lot of whipsaws, and not good. Then they add the 9-day moving average to the MACD and called the MACD. And then decam is slightly better than MACD. It has fewer trades. It's my timer, so I like it. And here I will show you next the decam code. Here it is. The buy signal, three things: price greater than EMA 28, EMA 14 greater than EMA 24, stochastic 50,2 greater than 32, and the sell price is less than EMA, so 28, EMA 14 less than EMA 24, stochastic 50,2 less than 32, and that's the end of the show. Thank you all for my presentation, and next is Alan Porter, who will guide us through the next few minutes, and then we'll complete it for the day.
Right. Hold on one second.
Okay, did I stop sharing? Alan, you ready?
Yep, I'm up now.
Okay, good.
Okay, what I want to talk about is 18 risk in retirement that people have no idea about. Let's start off with people invest in the 401k. The 401k, even the inventor of the 401k, Ted Beanius, said it's a disaster, it needs to be destroyed. And the problem with 401k, 58% of the people don't even think there's a fee in their 401k. A 1% fee over a 30-year period will reduce your income by 1/3. But the average fee in the 401k, verified by Forbes magazine and Lat Times, is over 2.99%. People can have less than half their money, and then that's also taxed at ordinary income tax. So now they're going to be taxed between 20 to 55%. People are not ready for this. But I want to bring up something else. The 18 risk in retirement. Longevity risk. It's a risk multiplier, because the longer you live, all these other risks of retirement multiply. Inflation risk. We can see inflation, what it's doing in our economy right now. And if you're not planning for it, it's going to devastate you, and you're going to be living a much less much less desirable lifestyle than you are right now. Excess withdrawal risk. This goes right along with sequence returns risk, which I'll explain. And if you have excess withdrawal risk and just in a stock portfolio, you're going to have big problems because you're going to run out of money. Health expense risk. Health expense, the average couple at 65 are going to pay around $380,000 for their retirement, for their health care in the next 30 years. And people are not, they don't even have any idea about that. Long-term care risk. Now, this is one of the biggest things that I show people is preparing for long-term care. I have many people tell me, well, I'm never going to need it. Well, I have news for them, because 70% of all Americans are going to need long-term care at some point in their life. And right now it costs between $50,000 to $200,000 a year, and it goes up by 6% every year. And this is a surprising statistic. 40% of the people in long-term care are between the ages of 18 and 64. And there's an age lab study by Dr. Korsky at MIT University that if you're married and age 65, there is a 75% chance of you or your spouse contacting Alzheimer's, dementia, or Parkinson's. And I just put my brother, I'm 71, just put my brother in long-term care last year. He's 74 years older than I am. The state patrol caught him going down the interstate in the wrong direction. The state patrol called his daughter up, said he needed to come pick him up. He has no idea what he's doing. He has Alzheimer's. He's lucky he didn't kill himself or kill somebody else. Another thing that people need to understand is frailty risk. Every time, the older we get, our mind's not as sharp, and we're physically weaker. And as a result, we're more prone to making mistakes in our finances, let alone our health. Financial elder abuse risk. I see this happen all the time. People get talked into things all the time because they're lonely and they want people to talk to them. And it's really sad when it happens within a family. People turn all their assets over to their children, and their children take advantage of it. But that's another thing that people need to be aware of. Market risk, of course, market risk. Market goes up, the market goes down. The market goes up over a period of time. But in retirement, are you ready to take those risks? Are you ready for the market to lose 40% in a 6-month period? Interest rate risk. We've seen that right now. People can't afford anything. The credit cards right now are tremendous. They're up to 25 and 30%, but the effective interest cost they're paying those credit cards is over 95%. And I'll go over effective interest cost in another interview that I can do. Liquidity risk. You know, some of your risk in the market they're not readily available. You know, like a CD or something like that. It's a 6-month CD or a year CD. If you take it out before, there's a penalty. And there's other things out there that have no liquidity whatsoever. Now, I spoke at Harvard about having liquidity, use control of your money. And if you don't have liquidity, you don't have any control of your money. So you've got to have liquidity risk in your stock portfolio. But this is one that just gets me now, because I've got hundreds of clients, people that are anywhere from 50 to 75, and their financial advisors who are paid to fee never tell them about sequential returns risk or any other risk in retirement. But sequential returns risk, let's say you're 65 and you got $1 million in a stock portfolio. They used to say a 4% distribution rate was a safe distribution rate. Now it's down to 2.8%. But that 44% distribution rate is $40,000 a year. But let's say you have a downturn in the market in the first 2 to 3 years of a 10-year period or 20-year period. Well, you take that $40,000 out in year one, the next year you have a 10% decline. Now your your portfolio is down to $900,000 minus the $40,000 you took out, minus the fees you paid to that financial advisor, whether you make money or not. And you've got that sequence returns risk. If you want to go out and get $40,000 the next year, you've got to take out maybe 7 or 8%. If it does it again, now you're talking 15 to 20%. And you're going to be out of money in the sixth to ninth year. But I show people how to take advantage of this and take approximately $650,000 of that stock portfolio and put it into a fixed indexed annuity that I sponsor. And it gives you the same $40,000 a year, and it's guaranteed for the rest of your life with increasing income to counteract for inflation. A stock portfolio cannot do that. And that leaves you $350,000 to do with what you want. You can turn that into a Roth, which now has no required minimum distribution, which many people don't know about in retirement. It also eliminates the tax risk and taxation of Social Security and the means testing for Medicare Part B, which is going to be in the thousands per year. Now, also, it's just the benefit of having guaranteed income in retirement. It's health changing for people because they're always worried. The number one fear in retirement is running out of money before you run out of life. Forced retirement risk. What happens if you're not ready to retire, but your health or family obligations or job loss could force you to retire and begin earlier than planned? That happens to people all the time. Reemployment risk, like forced retirement risk, you have no assurance that they're going to rehire you. Your skills may not be even needed anymore because of even what's coming out with AI. And some people don't want to hire a 65-year-old because they've got these younger kids that will work for less money. Employer insolvency risk. This is absolutely huge. It's just like people that worked at Radio Shack. Now they shut them all down. Now I just saw where what's it called? The Red Lobster. They went bankrupt. Now they're shutting down all their restaurants. Heckinger Lumber Company shut down all theirs. You're never insured. I mean, you're never guaranteed employment. Loss of spouse risk. People don't understand this, especially when the primary breadwinner goes. And 84% of widows are female, and they don't understand because their taxes can go up because now they're single, not filing joint, and your Social Security can drop anywhere from 33 to 50%. unexpected financial responsibility risk. This happens especially with kids coming home to live, or you're caring for an elderly parent or something. You just can't afford to do it. You're having trouble making a living right now, but having this unexpected financial responsibility added to your present financial situation, it can be life changing. And timing risk. You know, you can't time the market. If you could, there'd be millionaires every place. But there's no timing. You can't do this. And many people tell you that you can time everything, any advisors, but I've never seen a timing risk that works. And then excuse me. And the last one I want to go over is public policy risk. Now, here's the thing. You know, I asked people, I said, why do you contribute to a 401k? And they all tell me, well, Alan, it's a tax deduction. I said, no, it's a tax compounder. What do you think the government wants you to do? Pay taxes on the seed, the smaller portion, or the harvest? And that's going to be at a tax rate that the government's going to say in the future. And this is a Congressional Budget Office report in the fall of 2022 on a $31 trillion deficit. If we don't raise taxes overall by 66% by the year 2030, we can't even pay the interest on the debt. The country will go bankrupt. So what have they been doing? They've been printing more money, causing inflation, and raising the interest rates, which causes inflation. And right now, our debt's over $34 trillion and growing. Something's got to be done because people are not understanding the consequences of this. You know, another thing, I want to stop sharing here, but another thing that I talk to people about is, you know, when you're talking to people about retirement, you need to consider all avenues out there: the stock and bond portfolio, fixed and fixed indexed annuities, cash value life insurance, which is, in my opinion, and opinion of many educated advisors that deal in the insurance products, is the best tax code approved, tax-free retirement system available today that eliminate these risks in retirement that a stock portfolio, bond portfolio, real estate, or savings account or CDs only compound. And I'm very passionate about this because, you know, when I got started in this, I didn't think I'd ever be a financial advisor. I'm retired Black Hawk instructor pilot. I retired back in 1993. And I tell people I have a safe landing for every takeoff. And I dodged all the bullets. Had a great career. I had a successful real estate mortgage business up to about 2008. Now, I live in Fayetteville, North Carolina. My son lived in Little Rock, Arkansas. He was married with his wife's 39, had two little girls. They were 7 and 4. And we went out there for Christmas in 2009. Well, my son had been 100% disabled for over 3 years and not getting a disability. They hired an attorney, finally got his disability that summer. But we came back January 5th, changed my entire life. Lynn, his wife, called me. She said, Alan, I've been diagnosed with stage 4 pancreatic cancer. They've given me 6 months to live. Of course, we were devastated. But if it had not been for the terminal illness rider, her life insurance policy, let her access the death benefit, which was hundreds of thousands of dollars, completely tax-free, which I had no idea about, my son would be bankrupt. And it took a huge financial strain off of me. And these things, what I'm doing is I'm educating people to think outside the box of conventional financial planning. I show people how to reduce and possibly eliminate both debt and taxes, set them up with a tax-free retirement. And I show people how to become their own bank, borrow from themselves and pay themselves back, eliminating the compound interest they're paying to the financial institutions that compound for them and not the individual. But the biggest thing I do, especially for people in retirement, is I eliminate the risk in retirement, as I said before. There's many things out there that people don't understand. They don't understand about effective interest costs. And I teach people about that. It's just a matter of education. And I have a lot of people tell me, well, Alan, why isn't this put out before? Well, understand, I'm a certified financial fiduciary. And I'm also a certified tax and business advisor. But the things I teach are outside the realm of conventional financial planning. And my biggest thing is to educate people on the advantages of insurance products. I've spoken at Harvard. I've spoken at West Point. I've got my own show on Consumer News Network out of Denver. I've written on my 8th book now. I've got my own national podcast, and I've been seen on every major television network across the United States. So I'm very well versed in everything that I'm saying and educated in it. I tell people, you know, when I was in the military and I was flying, I was Black Hawk pilot, but I I read that back and forth. I knew every nut and bolt to that helicopter, and I've had many emergencies. I knew the stability augmentation system, the flight path stabilization system, and when I had an emergency, I got it down without loss of life or loss of equipment. But I do the same thing when I do my financial advice. I read probably 4 or 5 books a month because you cannot learn too much. Now I've had affluent clients tell me, Alan, my CPA, my financial advisor, and my attorney give me all my tax and financial advice. I said, listen, I'm not here to replace any of your advisors. Now they may be the greatest advisors in the world, but it's what they don't know that's going to cost you hundreds of thousands, if not millions of dollars, and undue taxes, fees, and lost opportunity costs. I got 2 questions for you. I said, when's the last time your advisors give you any proactive advice on saving taxes? It's usually slim to never, because your CPA wants the correct numbers for your tax returns. Your financial planner is trying to find you the best possible financial vehicle, and your attorney is worried about legal documents. Not everybody can know everything, and that's why I have a team of people that I collaborate with. If you want a stock portfolio, I have people who will do that, but I collaborate with top CPAs and tax-specific attorneys and other specialists in their fields to provide people solutions for their financial problems. I really appreciate being on the show today. I hope people would like to talk to me. My number is 910-551-1046. My email is strategicwealth0@gmail.com. And my website is strategicwealthstrategies.com. Thank you for letting me speak today.
Hey, great. Thanks for the show. We are very happy to have you, Alan. Good presentation. What you're saying about market timing is probably right. I discovered over the years, but I did call the crash in 2008, and I won the World Cup Championship of stock trading that year. It was a great effort. I was up 48%, but you can't do that all the time, unfortunately. But through the years, I've made discoveries. But buy and hold. The one thing about buy and hold is that they think that 7% is a pretty darn good deal. It really isn't. And I don't like that. I just don't like the idea of a 60-40 plan being Mecca. It isn't. So I designed stuff, and I look at 4 things. I look at return on equity, gross margin, current ratio, and free cash flow. And I'm getting 24% a year. That is just terrific. I mean, nothing can outclass that. I mean, it's just a great feeling to know that I don't have to worry about this stuff. Waiting for the whole signal to turn, all this stuff. Forget it. I'm tired of it. Really, the large caps I'll hold up nicely. I might be timing the small caps, but the large caps actually hold up very nicely up and down and everything like that. But it's a matter of finding them. And Warren Buffett, you rely on the experts. What happens is that people marvel at the experts. They don't know how to do as well as they do, but they don't care. So they're basically fed dog biscuits in the stock market, and no one knows how to outperform the market. And it's just a dog and pony show. I'm tired of it. Really, I am. So I did my stuff, and hopefully people subscribe. But that's another thing. You do as best you can. I'm a 2-time world champion and now #1 newsletter in the nation. And I have just a few people that are subscribing. So it's very the effort has been pleasure. Actually, the pleasure is in investigating this stuff, but I haven't been able to get a whole lot of attention. And maybe it's disappointing, but that's the way it is. And I shouldn't fight it. Thinking bad thoughts about it all day long is not going to get me anywhere. Okay, everybody, thank you for for attending. It's been great. Great for people to express themselves, share their feelings. That's great. I like that part of it. Performance maybe okay, but it's a matter of does it work out, and we're going to go into another market spill and nobody catch it. Okay, Matt, that's the end of the meeting.
All right. Well, thank you, Alan. Thank you, Brian. For those who have not subscribed to the Money Smart Show, go to I post the chat there, and also sign up Brian's Moon Run Report at moonrunreport.com. And we're actually going to be adding more AI assistance on all the different indicators that Brian went over in the podcast. Anyway, thank you for joining us. Well, see you next week.
All right. Thank
Okay,
you, guys.
thank you, Matt. Thank you, Alan. Great presentation. Thank you for all your effort.
Appreciate
Thank you,
it.
Alan.
Thank you.
Bye-bye.
Okay,
a great-
bye-bye.